Hey gang, Dennis Tubbergen here with another market analysis. Today is April 9, 2018, and I have on the screen in front of me an article written by John Hussman, whom I have a great deal of respect for. And he starts out the article with a quote from Roger Babson. The date of the quote is September 5, 1929. We all know what happened about 6 weeks later. Mr. Hussman starts the article by saying Roger Babson's first rule of investing was to keep speculation and investment separate. He's remembered not only for founding Babson College in Massachusetts, but also for his speech at the National Business Conference, warning of an impending crash just 2 days after the 1929 peak, at the very beginning of a decline that would wipe out 89% of the value of the Dow Jones Industrial Average. As I've observed before, Mr. Hussman writes, the backstory is that Babson's presentation began as follows. I'm about to repeat what I said at this time last year and the year before. The fact is that Babson had been proven wrong by an advance that had taken stocks relentlessly higher, doubling during those 2 preceding years. Over the next 10 weeks, all of those market gains would be erased. If Babson was too early, it certainly didn't matter. From the low of the 1929 plunge, the stock market would then lose an additional 79% of its value by the eventual bottom in 1932. Now, the lesson, Mr. Hussman writes, has been repeated. And of course, I'm showing you this article because for approximately the last 2 years, I've been saying that the market is overvalued. Certainly the timing of the correction is something that I have not been right on either. But Mr. Hussman writes, this lesson has been repeated to varying degrees at every market extreme across history. For example, the 1973 to 1974 decline wiped out the entire excess total return of the S&P 500 index all the way back to October of 1958, nearly 20 years. The 2000 to 2002 market decline wiped out the entire excess total of the S&P 500 all the way back to 1996. The 2007 to 2009 market decline wiped out the entire excess total return of the S&P 500 all the way back to June 1995, 12 to 14 years. He continues by saying, I expect that the completion of the current market cycle will wipe out the entire excess total return of the S&P 500 index all the way back to about October of 1997. That outcome wouldn't even require the most reliable valuation measures we identify to breach their pre-bubble norms. Now, here's a chart. Take a look at the tech stock peak. Up, down, just about back to this 0% line. If you take a look at the 2007 peak, it was back down below the line, and now look at where we are again. I am looking for, as is I think Mr. Hussman, a significant decline in the stock market. And even though we may warn early, and even though tops are difficult, if not impossible to pick, it's impossible to ignore the red flags that the market is putting out now. So my advice, make sure you hedge your stock positions, make sure you have exit strategies, and make sure that if you do continue to own stock positions, that it's on speculative parts of the portfolio, not on part of your investments, to paraphrase Mr. Babson. That's today's market analysis. It's April 9, 2018, and I'm Dennis Tubbergen.